All right. Hope everyone's doing well. So I'm just going to review the SPY. This is the chart of the E-mini. However, they're so I mean they're basically the same market. They're very tightly arbitraged. So it won't matter which one I look at. And it's easier to explain things in terms of the E-minis, just in terms of the E-mini because of the point value. It's four ticks instead of 10 ticks for a minimum scalp. So overall, by the way, please comment if there's any audio issues. There should not be. However, I'm using a different computer to record, and I think that should fix the issue. Overall, let's look at. Sorry about that. So overall, kind of having to get used to the controls. Let's look at a daily chart, very tight channel. Probably going to have to reach, hadn't reached the moving average in quite some time, probably will reach it. Still, I mean, very tight, so, difficult to sell. May have to go sideways for quite a while. You can see weekly chart outs talked a lot about this. We're very close to the all-time high. Very climactic. Only really three bear bars since the start of this year. So very climactic, and probably have to go sideways. Stops, the stop's far away. Arguably, it's down here. However, you got to think, what's the real? You got to ask yourself. Here's the high. So if your stop's down here and a 1-to-1 risk reward's here, probably not 60%. I think the reality is, I'd be surprised if a trader selling here is probably, price will probably come down here or attempt to before it gets all the way up here. Now with that said, anybody taking that trade, they're going to sell higher. So I don't think it's really a great trade. It's kind of like the odds are, you'll probably have to have a micro double top before you get some sort of sell off. So selling here, what I'm saying is price will probably have to go sideways before it sells off. So there's no real rush to do that. 60-minute chart. That is just annoying. There we go. Broad channel, but is it really that broad? I mean, you can argue it's broad, sideways for many bars, breakout sideways, breakout sideways. Still pretty difficult to make money selling below bars. So I say it's broad, but look at a bar. Sell any big bear bar. You sell here, you lose money. You sell this close, goes down for a small second leg. You sell here, just barely goes down. You sell here, you only made money if you're willing to scale in. And the reality is traders aren't selling here. They're selling here above bars, taking profits on here because they know bulls are going to buy 50% pullbacks. So traders are mainly trading this like a trading range. I mean, you could certainly do that every time it goes above bars, goes above this high. And by the way, I don't know how to turn this little hand thing. I find it annoying. The reason for it is TradeStation now does background dragging like this instead of or this, which I mean I get it. It's kind of, I don't mind it. It's kind of convenient, makes it a little easier. You don't have to. Used to a TradeStation, you'd have to enable background dragging. So it's got its pros and its cons, but it's kind of more of a pain to. I've got to directly hover over a bar, but they'll sell above. And when I hope you can see this. I'm sure you can. When I click on this bar, obviously I'm talking about the bar above it. So if I clicked here, I'm really talking about this bar right here. So traders will sell above this bar right here. They'll just make money. Will traders sell above here? I mean, some will. However, the reality is when you see a bar this strong right here, traders are not going to sell at the high. They're going to sell, you know, maybe at the second entry. So if you think about it, if you're, let's say you're going to sell this high. I'll try to get over here, we can see it a little better. If I'm going to sell this high and I see it trickling up, just barely going up, I'm more willing to sell at the exact high and scaling higher. You know, maybe use a stop and measure move up like this. However, over here, when you see a strong breakout bar surging up to the top, the reality is you can use this stop. You can, you know, sell, put a stop up here. However, when it's that strong, you're probably going to get a little more up. So rather than sell here, why not sell at your scaling entry? So if you knew you were going to sell here and maybe sell halfway to your stop, let me just paint that blue. Almost forgetting how to do this. No. Oh, it's negative 50. Whoops. There we go. So maybe rather than say, hey, I'll sell, normally a logical thing to do is to sell here and sell halfway up to your stop up here and get out back at your original entry, or on a 50% pullback, maybe a test of here, strongest breakout in many bars. You got to think this channel goes way back here, so it's probably exhaustion. Maybe instead you say, I'll sell closer to my stop, or strong bar, weaker bar. Okay, I'll wait for a second leg. I'll sell below here. So you don't want to necessarily sell with limit orders on strength, especially in the tighter the channel, the more dangerous that can be. So yeah, let's go to the 5-minute chart. Well, and again, 15-minute chart kind of shows you a close up. You know, again, when you see this is very parabolic, very climactic. But when you see this, traders are not going to be as willing to just sell a new high because they know this is so strong. You got to think about breakouts for a second. Why does this happen? Why does this happen? Well, this happens because people are selling very aggressively, or they're trading with the trend very aggressively. So they're buying aggressively, selling aggressively, because they know that the first reversal is going to fail. So I could buy this close, buy more lower, scalp out. Buy this close, buy more lower, scalp out. Or I could buy this close, scalp out. Buy this close, scalp out. So, you know, that's why scalpers love buy the close markets, because you can buy all the way up. And even if you bought this close, you can buy more lower and you get out back to your original entry. You buy more lower, get out of original entry. You buy above here, scalp out. They know it's going to go sideways for many bars. Even over here, you know, they know the reality is, okay, sure, big bar, it's a 2-bar breakout, but it's in a trading range. Is it going to go down a measured move? Well, I don't know. Maybe not. You know, here, this is a lot stronger because you're closing above many bars. Therefore, you're more likely to go up to here. It's higher probability. But what traders do know is it's a tight channel, probably going to get many legs down. So I'll sell this close, scalp out. And this bull bar tells traders the traders that sold took profits at new lows. Therefore, you know, you got to think about this. I'm not trying to bounce around, but I'm just trying to give you some thought process. You have to think about this from the perspective of the other side. So a bear, you know, think about it like this. It's clearly going down. The bias is to the downside, but what can the bulls do to make money? Well, the bulls that bought this close made money, okay? The bulls that bought above here did not make money. The first reversal down will fail. It's the same thing I said over here. Traders are selling knowing the first reversal up is going to fail, so they'll sell aggressively. And they'll sell, scale in, get out at their original entry. Traders will buy all the way up, and when they're disappointed, this bear bar is disappointing just as this bull bar is disappointing for the bears, they'll buy, get out of break even. So if you're aware, you may trade smaller, buy more lower, get out of break even. And once that happens, traders will generally stop selling above bars in this case, or below bars in this case. So this bar, I don't really see traders I know some people will, hypothetically, they'll buy above this bar and get stopped out at a new low. I don't really think a lot of traders really do that, though. At least for lack of better words, you're smart traders. Most people know computers will do it, don't get me wrong. Most people know this is very low probability, but what it tells them is this: okay, what I'm going to do is I'll buy this bar and I'll put a stop, maybe, I don't know, all the way down here. Who knows? You probably need one wider than that, but they'll buy here and they'll buy more above a strong bull bar, knowing most of the time they can get out of break even. So if they bought here, they may wait for this bar right here, buy more, and look what happens. It lets them out break even. The scaling traders generally can avoid a loss like 90+% of the time. Now again, this just tells traders that bears are taking profits and bears are going to start buying below bars. Look every time you make a new low. New low, find buyers. New low, found buyers. Eventually, you have a strong enough rally, makes people think it's in a trading range. New low, strong buyers. But up here, traders know it's going to be sideways. So anyways, I want to really, it's easy to kind of just ramble, and I don't want to get sidetracked from what I really wanted to talk about. So I want to review the week. Now, again, as I was talking about with buy the close, sell the close, strong outside down bar. I really want to get rid of these session breaks. Well, I'll keep them one for y'all. Some of y'all may like them. I don't like them. I never look at them. It's just a distraction. So outside down bar, traders will sell, but they know the first reverse low will fail. So when they see that, they're disappointed. They scale in higher, scalp out. That's exactly why this happened. So traders, as I said earlier, this tells traders, a lot of traders I don't think will buy here and get stopped out. They'll do exactly what I told you on the 15-minute chart. They'll buy here, buy more below here, put a stop somewhere down here, get out at the first entry. And look what happened right here. It went up a little, turned down. Now, I think the better trade, I don't think it's a great buy, because the odds are we'll get a small second leg down. Now, a trader that's aware of this may think, okay, here's the high, here's the low of the day. If I buy right here, maybe there's a 50-50 chance it's the low of the day for at least a few bars and two legs up. 40% chance maybe we get up here, maybe higher than that. But it's a very good probability for traders to buy above this bar, stop down here. And this bar, what happened right here? Well, this little bear doji, traders trying to get out, break even at the low close. So when you see this bar, again, and it's a few things. You have bears trying to get out at the low close. You have bulls who bought this bar knowing it's a big bar, so you have big risk, low probability. So some traders are trying to get by a pullback. You think about it like this. Okay, we're over here. We're right here. Here's the low close. Instead of buying above this bar or the close of this bar, I'll try and buy a few ticks above this close. That's what happened. So, anyways, I'll get to that. Let's go to the actual start of the week, which is the 22nd. Okay. So we have a gap down, 3 consecutive bear bars, clearly always in long. And really two things are going to happen. Well, one thing. There's a 60% chance of at least a little more up. So what that means is it doesn't necessarily mean a measured move up. You're in a trading range. So 60% chance the market's going to go at least sideways to up for several bars. So anybody buying has a high probability of more up. So you buy the close, stop down here. You can get out here and buy more lower, the odds are this is not going to reverse this. And when I say this outside down bar is not going to go down here, which is probably true. It is true. So a lot of traders, what happened here? You have a strong breakout. Traders will buy 50%. I'm going to do this a different way. I want to do this. I'm going to talk about always in on the day. Then I'll talk about stop entries and limit orders. And then some overall thoughts. It's easier that way. Always in. Probably always in long on the close of bar 1 or close of bar 2. Higher probability to wait for bar 3. This bar. Bulls can get out below. They don't have to. If they do, they've got to get long again. Really no clear place to get long again. You're buying pretty high up. You're buying high up. Odds favor a small second leg down. Bulls can buy here. And if they do, maybe they get out along below here. Starting to form a trading range, so always in is not a great environment. And you really just went sideways the rest of the day. This is the problem. If you're trading always in through this, you're doing the opposite of what most institutions are doing. Institutions are selling above bars, buying below bars all the way through. So if I was trading always in, ideally you stop trading always in through here. You're going to get chewed up. And stop entries, you can buy above here, buy above here, buy above here. If you do, maybe you get out below here. You can sell here for a quick scalp. Maybe you buy above there, but again, not a great trade. Stop placement's difficult. Arguably, stop still down here. That's an okay stop entry. Okay stop entry short, but tight channel. Small spike in channel. So really not that great. Probably minor. May just test these lows. Bad stop entry. Top of the range. Pretty, tight little micro channel there. Okay stop entry, but again, kind of very tight trading range. If I did buy, probably wouldn't get out there, but I'd probably just get out over here, maybe below that bar. And that's pretty much it. You can buy here, but again, tight trading range, not a great trade. Small doji. And traders are going to sell above and scaling higher and get out at their original entry on this bar. Limit orders, everything was a limit order. So this told traders probably at least, probably not going to have a bear trend. But you can see traders bought below. They bought below this bar. They bought more below this bar. They sold the high of this bar, scaled in higher, got out, break even over here. They sold this high, scaled in higher. They bought these lows, scaled in lower. They sold above these bars, scaled in higher, got out, break even. I mean, you could have bought or sold anywhere and scaled in and pretty much made money. Lots of bear bars down, strong bull bar, probably not going to get another strong bull bar, sell the close. High one buy, doji, bad bar, sell above it. Buy below this bar, sell above this bar, buy below this bar. But again, kind of difficult because you may get a little pop at the end of the day. So the very next day, fairly tight channel, not a great short below bar 1. Bar 2, can you buy? You can. And you get a little follow through. So always in long on the close of bar, maybe bar 2, but not a great trade. I'm tempted to say if you bought this close, you probably get out below the bar, but it never triggered. I say that there's a pretty big tail. You probably hold long. So if you bought, here's my problem with buying up here. And I want to explain this real quick. If you buy this close, stop down here. A measured move is here. And you got to think to yourself, okay, 60% chance, maybe. But, you've been going up for 20 bars, best looking bars in the trend so far. You may not get this, especially when you get this bear bar. I don't think the probability is 60%. Therefore, you probably need to be able to scale in. Your stop probably needs to be down here. So a lot of traders are going to get out break even. And then you get this, and you get the strong surprise bar. Then you get this bad follow through bar. And then you get this, you keep going sideways, and eventually you break out to the upside. So, but I know what you're thinking. You just said it was low probability. It was. This is very difficult to trade from a swing perspective, which is why this happened. Why did this happen? This was not high probability. You have to think. High probability trades are, let me restate that. High probability trades are bad risk reward trades. So what does that mean? That means that a trader taking a bad risk reward trade isn't going to get many times their risk. You know, a trader buying here or here, I mean, they got, price went up, more than one times the risk. Their actual risk was tiny. So what happened here was a lot of traders got trapped. So, you have a lot of traders selling above bars, betting on a wedge top and at least sideways, and we pop to the upside and trap them. So always in, yes. Ideally, you buy the close. Maybe you get out below the bar, but it never triggered, so you stay long. Then maybe you get out here, but you got to get buy again. But then you get out here below this bar. It's really, really difficult. And the reason is, bears are making money above bars. However, here they got trapped. Here they got trapped. So it can be very, very tricky. It's a tight channel. Traders do not like this environment. Most people who are scalping do not like this environment because it looks so much like you're going to reverse, and you don't. You get this. They like this though. So it becomes high probability buying in here. Like I said, you could always end buy above, but maybe you don't get out here. You get out here, but you got to buy again. Do you get out here? I don't know. Parabolic 3 pushes up. You can, but you got to get long again. Maybe you get out here, but you got to get long again. So you can see how you could easily get chewed up. But then you get these, 1, 2, 3, 4 consecutive bull bars. You have to be thinking, okay, we have a wedge top. We're not testing down. Maybe we're testing up. Boom, we got a breakout. Then we got a follow through bar. So clearly by the close, probably stop down here. Even if we fall below this bar, probably a trading range. So not a great stop. Clearly always in long, but you can buy for any reason. First reversal down should fail. You can argue parabolic, but not great. Maybe first push, second push, third push. But again, extremely tight channel. Even if we test the moving average, which by the way, there's an issue buying up here. Yes, if you buy, we're probably going to go sideways. However, we have not touched the moving average all day, and there's like a 99% chance you're going to touch the moving average every day. Find a day where you haven't touched the moving average on a 20-period moving average. It doesn't happen. Let me just make sure, speaking of that it is a 20-period moving average. I'm nearly certain it is. See, TradeStation it's hard to click on things now. Okay, it is. Which I like the new app platform, but it's like I said, the computer I'm using is a little bit smaller. But sometimes it's hard to it's hard to grab the measure move projections. A lot of times I'll just delete it. Move on. Anyways, tight channel. First reversal down is probably going to fail. Traders will buy it, but again, we hadn't touched the moving average, so you got to ask yourself. Let me try to think what I'm doing here. There we go. So here is price. Here's the moving average. It's kind of like saying, do you really think we're going to go? And we might. I mean, this is a low probability day. Are we really going to go all the way up there before we touch down? I don't know, maybe. And in fact, we did. But that does not normally happen. This is unsustainable. But traders are buying because we know it's probably going higher. And it's a FOMO trade. Everybody wants the pullback, but nobody wants to miss the pullback. So they're buying, trading small, willing to buy more lower. And by the way, and it's getting parabolic. First push, second push, third push. 1, pause, 2, pause, 3. Best looking bull bars in the rally, probably a small second leg up. which was this bar, and then you test down to the low of this bar. This happens a lot. You hear I'll talk about in the video course. When you get a breakout, you need to trade small and enter, because a lot of times you may get this where traders are afraid to buy, and then they finally say, finally a second entry buy. I'll buy here, put my stop below. The risk is small. Well, what I just say a few minutes ago, we have not touched the moving average. Do you really think we're not going to touch the moving average when we get this close to it? It's a magnet. Here, we didn't touch it, which is kind of surprising. Normally, and this is another problem. When you get this close to the moving average, you generally touch it. Let me try to find a day of something kind of similar. Yeah, okay, like here. Big breakout. Well, moving average, always a magnet. Do you really think we're not going to touch it when we're this close? Of course, we're going to touch it. Here, obviously a big gap up. It's very strong. Well, do you really want to buy this high, this far away from the moving average when you know there's a 99% chance you're going to touch it? Probably not. And then you crash down to the bottom. So now let me go back to the 22nd. Here we go. 23rd, excuse me. So problem here, didn't touch the moving average, probably will. Over here, again, same thing. Probably going to touch the moving average. So if you're buying, putting a stop down here, terrible mistake. You need to buy, put your stop probably down here. And this is a, very climactic. The strong bulls took the difficult trade. They bought over here. Weak bears are not, let me put it this way. You have to have, once everybody's done buying, you're going to go down. Strong bulls took the difficult trade. They're not buying all the way up here. They bought down here. They would not exit if they just thought we were going to get this. They would stay long. Strong bears are not going to exit up here. They are saying, wow, this is a lot of value. Here, more value. Here, more value. I'll just scale in. I'm getting to sell at a really high price. What a great deal. The weak bears, they'll sell up here. They'll sell here. They'll panic out. And, they won't sell anymore. They'll buy back their shorts, which is what happened over here. Weak bulls will buy saying, okay, I've got to get long, but then they're going to get scared and they'll, sell out of longs for a short. So the reality is strong bulls are going to wait at least 10 bars and 2 legs, but you got to think, as climactic as this is, it could be 10 bars, 2 legs on a 15-minute chart. So we may not go much higher for the rest of the day, but probably going to go a little bit lower. And that's what happened. So you can see, trying to form a bottom, we're touching the moving average, and we went below it here. A reasonable buy may test the high of this bar. Never went always in short. Bears could not do much. They could barely, I don't even think they got below this exhaustion bar. So probably going, they didn't. So may try to form a double bottom and get a measure move up. Weak rally, fairly disappointing. A lot of bulls are going to start scalping out. High one buy, top of the trading range. Not a great buy. Then you get a low 2 short. I'd get out of shorts. You get out of longs there. And this is just a bad environment for stop entries. Then we broke below, but 14.30 late in the day. It's an okay buy, 2 legs down. It's kind of nested, leg 1, pull back leg 2, or leg 1, pull back leg 2. But it's an okay buy. And then there's the end of the day. So, never went always, just buy for any reason the whole day. Over here, scalping mode, trading range. So, again, probably always in long. Well, let me restate that. Coming into Wednesday the 24th, you're low in the trading range, so better to buy. But again, no clear always in direction yet. Second entry short, here's a second entry short for a break below this trading range. Traders will sell, stop up here. And disappointing follow through. What does this tell you? Well, a lot of the traders that sold scalped out. So when you see this on the open, you generally know most of the time you don't get a trend from the open of the day. Even though this, we just went up. That doesn't happen most days. So a lot of traders, when they see this, they'll sell and they'll scalp out because they know that. So get out of shorts above this bar. Probably always, it's a double bottom, maybe a wedge bottom. Bulls will buy above. Disappointing entry bar. It's small. More disappointment. Let me try to blow this up a little bit. But it's okay to be long. I'd rather be long than short. Are we gonna? The Bulls want to measure move up, so always in long, 2 legs up in trading range. Got to be a little nervous. So 1, 2, 3, possible parabolic wedge on the open, outside up bar. Then you get a wedge. So 1, 2, 3. I would definitely get out of shorts. Below, probably always in long. Probably won't get a new low of the day. This could be the low of the day, but you got to be wondering. The market's trying to form a double top. So what do the Bulls want? The Bears want this. And when you see that, you always have to think, okay, trading range. The best the Bulls and the Bears can expect is 40 to 60%. So probably a 40% chance you get a measure move down. Good entry bar, probably going at least a little for a second leg down. Always in short, probably will get a second leg down. Maybe test the open of the day. High one buy, but not great. And then look, strong breakout. So as I said a minute ago, even though you probably will get a second, this is the problem with trading ranges. 40% chance you get this, which means 60% chance you will not get this. So, even if you're selling this close, when you get this and then you get an II, that tells you a lot of traders bought back their shorts at the close of this bar. So probably need to get out of shorts there. And a lot of traders will exit here. Would I scale in? Would I sell the high of this bar and scale in? Betting that you could do this. You probably will make money. However, the issue is, again, it's a wedge. I forgot to mention, by the way, it's basically a micro channel, very tight channel. I wouldn't do that. Strong reversal bar, trapping a lot of bears, probably going higher. So odds are you'll get a second leg. So I would not sell. And did bears make money? The high of this bar was 875. They needed 750 to make money. And they made it. So the bears made 1 point selling at this high. So probably a trading range, which means they'll probably sell this high. High one buy, traders will sell. Second entry short. So, will traders sell? I don't know. Forming a tight trading range, I'd rather sell above bars. Limit order market. Did bears make money selling this bar? Okay, bears made 1 point selling here, so more trading range price action. So is this a good buy? It is always in long, but bears made money selling below this bar. Bears made money selling above this bar. Tight trading range, forcing you to buy in the middle. Not a great buy. Maybe a triangle, but again, if I'd do anything, I'd buy above it, but maybe your stop below. It's not a great trade, and that's why. Tight trading range, bears made money here, bulls made money buying above. Bears made money selling above. Lots of bear bars down, 1, 2, 3, 4, 5, 6 consecutive bear bars. So if you buy above here, a lot of bulls will be quick to get out. So bulls bought, they said, hey, maybe it's a triangle, tight trading range. Second failed breakout of the high of the day. We tried to break out above it again, but we failed. So bulls will get out, bears will go short, and they will hope for this. Double tops, it's still reasonable. So strong bear bar, probably always in short, closing below mini bars, at least in here. But what will the follow through look like? Bad follow through. So that's a warning that this may be just a trading range. Bears see 2 legs down, but strong enough for a second leg. It's a surprise bar, so I would not buy above it. Low one short. And then I can't even tell. This looks like a doji. Whoops. This looks like a doji. It is. I wouldn't buy above it though. It's a very tight channel. So probably the first reversal up's minor, stopped up here. Still always in short. Disappointing. 2 legs up. Bulls bought here, they made money. So bulls are making money below bars. They bought here, scaled and lower, made money. So kind of a low too short, but no reason to buy it for at least for a swing. Strong breakout, kind of a surprise. 3 pushes down, maybe a wedge right here, but it's still probably going lower. So I certainly would not be long or buying over here. Follow through bar, probably at least a second leg down. Micro channel, 1, 2, 3, 4, 5, 6 bars, 7 bars, 8 bars. We broke below this low, so now maybe you can argue maybe a wedge right here. Well, not really, but maybe a wedge here. Very tight channel. First reversal up should fail. However, it's the best looking bear bar, close to the 60-minute moving average. You're going to find buyers below this bar. You found buyers below this low, this low, this low. You'll probably find buyers buying these lows. However, when you get a strong breakout bar like this, generally best not to buy the low, especially when you get a sell off that quickly. It's better to wait. So some traders will say, yeah, okay, double top, 40% chance to get a measured move. I'll buy around there and scaling lower, betting we close the gap. So strong reversal, 2-bar reversal on a 10-minute chart, 15-minute chart. It may look like this. So definitely get out of shorts. Strong entry bar. However, big down, big up. Trading range more likely. I do think we'll get up here because bulls will buy down here. They'll buy here and scaling lower. But the bulls doing that are, they're doing this. They're buying these lows and buying more down here, or even in here. They'll buy this low, buy more 50%, stop down here. So they're using a really wide stop. And then we're just, so clearly a trading range. Bulls will buy lower. So I think any bull buying here and buying more lower will make money. So, again, always in short. Probably get out of longs, get out of shorts above the bar. Aggressive bears get out above the bar. Bulls buy. But it's trading range. You're high in the range, 50% pullback. I think you're going to bottom. I think you're going to bounce. Excuse me, I got to catch my breath. I'm not used to. It's kind of hard talking this long at times. I'm just trying to think through this. So, anyways. Trading range, always in long. I wouldn't be long up here. I think the bears that sold this high will make money. They sell this bear bar above it, and they'll scale in, make money. But you always got to wonder. So, but again, you are low in the range. Higher low major trend reversal, but very big bar, so not a great buy. Think about the risk reward. So if I buy above this bar, stop down here. 1 times my risk is here, which means 2 times my risk is really what I need. Is here, probably not going to get it, therefore probably more sellers above, especially when you start to see this, and probably going to fall below the bar. Now we're starting to get a double bottom, tight trading range. Not a great environment for stop entries. Tight trading range, 50-50 chance you break to the downside, 50-50 chance you break to the upside. Consecutive sell climaxes here, 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 or here, here, and here. Probably going to get a second leg up, and I think we'll get back above these highs. We're very close to the open of the day, so may have to get there. It's only a few ticks above this high, and we got there. Strong enough breakout, probably will go a little bit higher. Bears were unable to make money here, so what they probably did was they sold here, sold more higher, got out break even. Tight channel. Probably going to close this gap. It looks fairly weak. So breakout, but fairly weak. Probably a second leg up, but probably will close this gap. And there you go. So bears made money selling this high, selling more higher. They'll probably sell above here and make money. When look what happened. Well, this might be the end of the day. Yeah. But they sold above, made money. So going into the next day. Oh, well, that was actually the past 2 days. And you can see what happened. So bears still made money selling above this bar. Tight channel, they'll wait, scale in higher, and they may have a stop all the way up here. Okay, so on the next day, big bear bar, strong bear bar, probably at least a second leg down, which means bears will sell the close, sell below it, but big risk. Therefore, you got to trade small if you're taking that trade. So traders will sell below. If they do, I gotta fix this. There we go. If they sell below, could just be a sell vacuum. Bulls clearly made money buying this low and buying more lower. So a lot of always in traders will sell below. They'll get out above this bar. Possible double top. They'll sell it alongs below. Aggressive bears will short. Strong bear bar. Let me do it like this. There we go. Turn the scaling back on. Strong bear bar, new low of the day. Bulls made money buying a new low of this day, so they're probably going to make money buying down here. Strong enough breakout, may get a second leg down, so not necessarily a great buy, although traders will take it and use a wide stop. So I think bulls can probably, I don't know, you can get out of longs above the bar. I think you should. You get a second entry short right here, but bull bar, it's probably going to fail. Bulls will probably make money, so I wouldn't be short down here. And that's why I went a little lower, kind of a micro wedge. 1, pullback 2, pullback 3, breakout to the upside. Strong breakout, probably always in long above the bar. Aggressive bulls will buy, but bears definitely need to be out of shorts. Possible second leg trap, 2 legs down on a broad channel. Also 60-minute moving average, we're breaking below it. And when you touch the 60-minute moving average, you generally go below every moving average. So when you've been in a bull trend, you fall below it for at least a little bit. So you can fall several points below the 60-minute moving average and it not be that much for the 60-minute chart. So bulls will buy above, weak entry bar, okay, follow through, probably strong enough breakout for a second leg, may test this high or this high. But again, the bulls want a broad channel. The bears want a broad channel. So, you got to be suspicious, okay? You got to think. The problem, double tops always form in a trading range, and the problem with them, same thing with double bottoms, is they never look convincing. You never think 40% chance we're going to break below here and go for a measured move, but it happens. So, and then look what happened. So we may just be trickling down. So when you see this, then you get a bear bar. It's a micro channel. First reversal up should fail. Big bar. Another big bar. Could just be a parabolic wedge. 3 pushes. 1, pullback 2, pullback 3. So I would get out of shorts below this bar. You're up here. It's a low probability trade, but always in bulls get out. Excuse me, my voice getting a little hoarse. Always in bulls get out, stop up here, because 40% chance we fall below this bar. So you can see what happened. Bulls bought the close, scaled in, got out break even. Now we have a second entry short. But this bar, again, 40% chance. Now we have a bigger wedge, 1, 2, 3, breaking above the high of the day. Clearly always in long, forming gaps. But as I said earlier, 40% chance we break below, but you have to be suspicious. Now I broke to a new high, and probably the low of the day. Parabolic wedge, but again, it's by the close. First reversal down, should fail. So bulls are buying some more. Probably going to test the, I just realized I deleted the moving average. 1 second. Let's see here. There we go. And again, it's just hard to click. I have trouble even just clicking on the, I just want to make sure this is a 20-period moving average. It's kind of difficult to do. Okay. So strong buying, probably exhaustion, but first reversal down should fail. Buy the close, but many bars. So bulls are probably going to stop buying closes and start buying below bars. Second entry short. Bulls will buy below. So you can see what happened. Bulls bought the close, disappointed, tried to get out of break even, starting to channel down. And you have to be thinking, okay, parabolic wedge, first push, second push, maybe third push. So the Bears are hoping this is just a tight channel and we just trickle down in an endless pullback. Might happen. Tight enough channel, the first reversal up should fail, but this is stronger than this. So you can buy here, but I wouldn't put the stop below the bar because we may just do this. And now we have a second entry buy, maybe a triangle at the moving average, a more reasonable buy, maybe stop down there. Starting to get consecutive bull bars, but ask yourself, does this look like this? No. It's consecutive bull bars in a tight trading range, lowers the probability, tight trading range, breakout mode, been going sideways for close to 20 bars. So even if you're buying, everything's lower probability than what it normally would be. So selling this bar has reasonable probability. It's not great, but it's reasonable. Maybe it's a major trend reversal. Here's the open of the day. Well, what you got to think is, and another reason why this new app is kind of there we go. So we're not far from the open. So selling here, you have to think, if this is a trading range day, which most days are, here's price. So are we going to go, we're basically deciding, are we going to go to the high of the day or the open of the day? 12:30. So I think whether or not we go to the high of the day, I think we're going to test the open of the day either way. As strong as this trend looks, we're just too close to the open of the day. We had too much damage done down here for the bulls. And then strong breakout. So probably at least a little bit higher, maybe a second leg. Here's a high one buy. Maybe that is a second leg. And then we closed getting a bear bar. And now we have a high two buy. But, what's the problem? Small little gap. So you have to always be suspicious about this. And then we get a breakout, then we get another small gap. But it does not look like we're getting that. We're going sideways for too many bars. We're undoing the strength of this. And now we have a double top. Maybe you can call it a bull trend line break, 2 legs up, double top. So maybe a lower high major trend reversal. And trying to test the moving average. So consecutive bear bars, first reversal up probably will fail, but low in the range. So not necessarily a good sell down here. And, the reality is we may go above this high and still test down here. And, there you go. We just did that. So and there we go. We touched the open of the day. The problem with trading ranges is exactly this right here. The odds are, just as this was strong enough for the first reversal down to fail and test the high, which I should have clarified over here. I was a little too focused on this. This is strong. So you're buying, traders buying down here. Traders buying up here, let me put it this way. The trader that buys up here and does not get out early, traders are going to do one of two things. If they buy up here, they're going to get out early, or they're going to wait and buy more lower down here and get out at the original entry. So when traders are, maybe they buy above this bar or they buy above this bar, that's basically their average entry. So they buy here, they buy more lower, they get out, break even. Happens plenty of times. So other traders will do that. Some will buy and say, screw it, I'll put a stop down here, and because I know we'll get back up here, which is what happened. So traders use this to take profits at the high. They saw this was a bad area to sell. We sold off sharply. So it's again a bad area to sell, and we'll probably sell off again. But going back to here, when it looks like it's sell to close. You say, gee, how, we're falling below many bars. We are. However, this is exhaustion. Second leg trap. The odds are we were gonna fall below it, but that was it. You may fall below it, find buyers, which we found buyers. So buying above this bar is not great. It's okay, but it's not great because you'll probably get a second leg, and it's probably just going to trickle up. So I guess really what I'm trying to say is it's not so easy to sell the close, put a stop up here, because what do you do when you get this? You very often you get stopped out just to see the exact same thing happen. So traders are flexible. If they're selling here, they're selling more up here. They're not getting stopped out at the high of the day. Think about it. If you sell up here, what happened here? Found sellers. What happened at this price again? Found sellers. Here, found sellers. What's going to happen again? You're going to find sellers. And then we touch the open of the day, and look what happened. So this day, if the open's here, and here's the close, it's a doji. Look at the 25th on a daily chart. Hate all these dang lines. I have to say, I have a smaller computer, so the scaling's nice. It's pleasant to view the new platform of TradeStation on this computer. I have a smaller screen; it's just more portable, and I like it. It's it's just more convenient to carry around with, but a part of me does wish they just rebuilt the old platform. I don't know how I should probably test it out. I may do that actually after this and just see how the old TradeStation would look on this computer. I'm afraid it would look small, but anyways, it's still a pain to kind of use. Let me go back to the 24th. Here's the 24th. So, looks like a perfect doji. Yeah, this 25th, excuse me. All right, so coming into Friday on the open, and I'm going to turn off the scaling because y'all don't need it anymore. Here's bar one. Doji. So trading range bar, probably sellers above, probably buyers below, and that's exactly what happened. We went above it, trader sold it, went strongly down, big tail. So what does the big tail tell you? It tells you that bulls bought into the close. If bulls bought into the close, bears took profits into the close. So if traders are doing that, what's happening? Well, that is trading range price action, which means, again, 90% of the time, bulls and bears can both make money. Traders buy this low, they buy more, they wait for maybe they wait for the close of the bar, and then they buy. But bulls made money buying this low, they're going to make money buying this low. So it is always in short. You can sell the close, but it's not a great short. It's tight channel, we're breaking below the channel. So yeah, I wouldn't buy above it because first reversal up should fail. It's a tight channel, probably going to have to go sideways for a few bars. If I did buy above it, probably better to use a wide stop and buy more lower. Big outside down bar, but you got to ask, what's the risk reward? Same thing over here. What's the risk reward? And better yet, what's the probability of the risk reward? So if you're selling this close, stop up here. You're 1 times your risk is here. So think about that for a minute. Are you really going to get? And you have to learn to think this way. The more you practice it, the easier it gets. But that is, if you sell here, put your stop up here. 1 times your risk is basically here. 2 times your risk is basically here. Do you really think we're going to go all the way down here? I mean, are we just going to crash all the way down? Probably not. So if you're trading this, it's not 60% chance you're going to go down to here. Therefore, it's not a great short. So think about it like this, though. Maybe if I sell the close, put a stop, maybe I do this. Maybe I sell 50%. So I take this bar, set a limit order at 50%, and I get filled. Well, twice my risk at that point is maybe somewhere over here. So I'm not trying to confuse you, but you got to think about it like this. Okay, if I instead don't sell here and try and sell 50%, I could probably make twice my risk. So then your math is far better. It's a stronger trader's equation. Remember, you don't want one-to-one risk reward is poor risk reward. Therefore, you really need high probability, at least 60%, preferably higher, that you'll get more in that direction. So anyways, outside up, reasonable buy, probably going at least, consecutive sell climaxes, wedge, 1, 2, 3, probably going higher. Bulls will try and buy 50% because it makes the risk reward stronger. And it's reasonable. You had sell to close bears, as I talked about in the beginning. They'll, sell more higher, try to get out break even. So probably going to test the top of this, wedge or kind of start of this channel. Probably going up here, but probably going to find sellers. Outside down, probably exhaustion. Again, as I stated, I may not have said this, but I want to mention it. Whenever you have bad risk reward, it's better to do the opposite. So whenever you have a bad trader's equation, as here, if you sell this close and 1 times your risk is, well, let me do it the opposite. If I sell this close, 1 times my risk is here, right? Okay. So therefore, if that's bad, it's bad math. If it's not a 60% chance you're going to reach down here, think about the opposite. What if I buy this close, put a stop down here, and put a target up here? Well, if you're saying, gee, that's better, you may say, okay, what if I buy this close and buy more halfway down and set a target up here? It's stronger. Okay, well, what if I don't buy here and don't buy more lower and I wait for this bar? So what at this point, this is the thing, Matt, it always changes. At this point, if I buy here, put a stop down here, the odds are we're going to go up to here, but at least attempt to, before we get down here. And that's true. Same thing with this bar. The odds are you're going to, and coincidentally, look at that. Everything happens for a reason with trading. And if I could ever click on this moving average, it'd be great. This is the problem. It's the kind of annoying thing about the new trade session. I have a hard time just moving stuff. But look what I just showed you. If I buy the close of that bar, stop down here, bet that we go up to here. Look right here. Big outside down bar. Well, if I buy this close, put a target up here and stop down here, it's in the same exact area. And it's support. So anyways, I know it's getting a little sidetracked, but can't help it. Micro channel, probably strong enough for a little more up. May test all the way up here. Breakout, follow through, probably going a little bit higher. Yeah, call it whatever you want, but it is a minor reversal. Big down, big up, probably trading range, probably going sideways. First reversal is probably going to fail, so traders will buy below the bar. It's not a great short. High one buy, maybe sellers above, may get 2 small legs down, but I really would not. I don't know. I probably wouldn't sell above it, even though you can probably sell here, scale in and make money. And look, they did make money. So second entry buy, but again, tight trading range forcing you to sell at the low. And you got to ask yourself, it's an okay sell. I mean, you can bet that it's a broad channel that will make a new low of the day. However, it's a low probability trade. If you're selling here, a lot of traders who sell this second entry, I think they're pretty quick to get out. I think, if you think about it, it's actually really good math to take low probability trades, but be quick to exit. So what I mean by that is, okay, I sell this bar, and maybe you see this tail and you say, it's bad probability, I'm gonna get out. But again, I'm not really saying that's a great trade, because what I say earlier, forcing you to sell low, bad math, it's low in the range, tight trading range. So again, probably gonna find buyers, and you did. But bears made money selling this high and scaling in. Strong breakout, strong follow through. If you did sell, probably better to just take a quick loss and look to sell again. Strong enough breakout, you're probably going to go a little higher. So it's very dangerous to it can be difficult to kind of structure this trade. So I don't really like selling high if it's that strong. Forming a micro channel first reversal down should fail. Probably buyers below for a little more up. You got a little more up. Here's a second entry short, but a doji, you're at obvious resistance. But it may take a while to get down here. And that's the problem when you get this. It kind of slows everything down. Bears become a little more cautious. Bulls started buying aggressively for scalps, or at least for a little bit. And you normally have to get into a trading range. So look, we have a buy, but all these signal bars are bad. Bad stop entries, bad stop entry, bad stop entry, weak follow through, big bar, big risk. Trading range, very tight trading range. Now have a triangle, 1, 2, 3. Are we going to fall below here? We might. But while this looks like a good stop entry, the problem with it is you're selling right at the moving average. So you got to ask yourself, we have not touched the moving average since 10 o'clock, since over here. So is it really that strong? Probably not. But this happens all the time in a trading range. You do not get the great follow through, and you say, oh darn, it's bad follow through, it's a second entry buy, I'm going to just buy back my short at the market for a small loss. And then you look, and then you go, yeah, I did the right thing, I got out of my bad trade, it's probably not going to go any lower, again, probably not going lower. And then look, you're like, what, how can this be? We went a little lower, we closed the gap. It's just trading range price action. Tight channel, micro channel. So it's deceiving. This is kind of deceiving. I don't want to sell down here because we're at a 50% pullback. We're at my target, the highs of these bars. However, buying is kind of tricky. If you buy and put a stop down here, micro channel may get a small second leg down. There's your small second leg down. So now we have a doji. Well, do I want to buy? I don't know. I mean, the reality is it's trading range. You probably could buy and make money, but it's not a great buy. And there's the reason why. It's just a high trading range. Now we have 3 pushes now. 1, 2, 3. Is this an okay buy? Well, sure. But the reality is traders are buying lows, scalping out. Bull bar closing on its high. At the moving average. Can you buy? Probably. But let's visit the risk reward. So that's 1 times your risk. 2 times your risk. Are we really going to go up to here? Or are we probably just going to go up to here? We're probably just going to this high. And if you think about it, what's the risk reward? Well, is it a 60% chance we'll go up to here before we go up to here? No. So it's not 60%, which probably means there's probably sellers somewhere up here. So it's a bad trade. And that's exactly why you got that. But again, what did I say about this bar and this bar? Well, if it's big risk, maybe I can buy a 50% pullback, and traders tried, couldn't do it. So traders sell, scale in, scalp out. If you sold this high, 275, maybe you sold more at 4 even, and then look what happened. 275, traders got trapped. And actually at the last second they got out. So you can see what happened right there. You had traders who sold the high, 275. They scale in more at 375. Price goes to 425. Then it lets them out 1 tick above their target. So if they sell at 275, they sell more at 375. They set a limit order to take profits back at 275. It falls to 250, turns up. Now what else happened? Well, bulls buy the low at 350. They try to buy more at 250. Couldn't break out to the upside. Then you get bad follow through, and you just go sideways. Well, it's only 2 o'clock. I was thinking it was later than this. I'll keep going with it. Strong enough breakout, probably going a little bit higher, but you always have to wonder. 3 pushes up, 1, 2, 3. Fail breakout of the high. However, you're breaking above a lot of bars over here. So you got to think, maybe we'll go a little higher. Probably better wait for second entry. You don't get it. Another breakout, so could be exhaustion, second leg up. But you don't get a great stop entry short. but bulls take profits. And we just kind of trickle up. So, possible measuring gap right here. Surprise bar. Bulls are trying to get out at the high of these bars. They're unable to. However, they sell this high, make a little money. Maybe they sell here, but end of the day, end of the week. Weekly chart. This is interesting. So, very strong bull bar closing when it's high. And you got to ask yourself, are we really, what's the odds that we go, this was strong enough for a second leg. We have a second leg. Are we really going to get all the way up to here before we get down to here? I don't think we will. I think there's a greater than 60% chance we'll go to here than here. Monthly chart. Very strong. Maybe, could be forming some sort of expanding triangle. But just very, fairly tight channel. I don't think we're doing that. Strong enough, may have to go sideways for many bars. Alright, hope you enjoyed this video. Please comment below if you have any questions. Thanks for watching.